That's interesting. So let's broaden ourselves out a little bit then in that case. It feels like we're naturally kind of heading in that direction. I think I have a sort of an idea from having talked about Axon, but what do you think makes your kind of style of investing distinctive or the right one for you, I guess, is the question. There's loads of different approaches people have, and my sense is that a lot has to do with how people think about things and what feels right to them. So tell us a bit about yours.
Yeah, so I would say that my education from this, or education in a lot of my investments, came from listening to a lot of Motley Fool podcasts, and also a lot of Rule Breaker Investing podcasts, which is the podcast by Motley Fool co-founder David Gardner, who he kind of coined this term of rule breaker investing. And whilst I don't follow it, to the letter, it does give a good indication of how I think about these things. So there are 6 core traits to his style, to what he calls a rule breaker investment. First, they should be a top dog and first mover in an important emerging industry. I think that so often it can be easy to be drawn into like going for the second or third or fourth best company in an industry because its shares look cheaper, it might be smaller, and you might be like, oh, it's, look at the potential, look at what it can do, look at what it can disrupt. You've got this leader that's so much bigger. Well, if it only gets half the size of that, it's a great return. The problem is the leader tends to be the leader for a reason, and that's because it's a better company. And when it's a better company and a bigger company, then it can bully the little companies and deliver better returns. So that's kind of it helps me avoid falling into that trap. The second aspect is a sustainable competitive advantage. Well, yeah. Third one is strong past price appreciation. This can be a really, really, really difficult one because it is so hard to look at a company whose shares have increased 200, 300% in the last 5 years, see how much cheaper the shares were, and be like, well, I don't want to buy it now. But that's kind of I think the way that lots of people look at just even a stock chart of the broader market. If you look at the entire market from the start, all you will see is a graph that goes up and up and up and up, and you'll see it up here, and you'll be like, well, the graph I'm looking at, that can only go down. There is no more up. So, it's really, that's a really something to fight past. So this is why it's a good kind of trait to have because, if a company has been good enough to generate strong returns in the past, it is fair to say that it's capable of doing that in the future. I think particularly for these types of companies, if you're looking at cyclical companies, then it's a bit different. But when you've got companies riding some kind of like secular trends, then it's fair to assume that they are capable of that in the future too. Fourth point is good management and smart backing. I mean, I like founder-led companies. I like companies with a lot of skin in the game. I mean, I just kind of spoke a bit about Axon and Rick Smith, co-founder. Even though his ownership is currently only 3 or 4%, which is slightly lower than I'd look for. I mean, his incentives are really, really aligned with shareholders. Um, the fifth one that he says is strong consumer appeal. I don't really consider this one that much. If a company has a strong brand, great. I think it's probably the weakest of competitive advantages out there. My Airbnb investment has basically done nothing for 2 or 3 years, and that's one of those examples of a very strong brand. And then the final point is the stock is considered overvalued by the financial media. Now, this is where my disillusionment came a little bit with this approach because I started investing in early 2020, just before the pandemic, in these types of companies. And these types of companies soared in 2021 and 2022. I mean, they flew. I think we all know like the ARK Invest, and how that did. It was crazy. Valuations were insane. And did I care about valuation? No. And what happened? My portfolio got absolutely annihilated. Like it just plunge. I think at some point in 2022 or 2023, I was down 50%. And I've only recently, and to be honest, I'm surprised it's kind of happened this recently, but this summer, my return since inception just overtook the return that I would have got if I just invested in the FTSE All World instead, which, to be honest, is my long-term goal, is just to be that. But, you know, I was way below it for a period of time. So whilst I kind of have his general approach in the companies I look for, I do also pay some attention to valuation as well. And I've kind of, I guess, outlined my my model there and how I try and get around these companies that can be difficult to value. And then I would say that the one other thing that's a little bit distinct is the fact that I can accept quite a lack of control. So I don't pretend to completely 100% understand the businesses I invest in. I accept that there are blind spots to every single company I invest in, probably quite large ones. I say I probably understand 70 to 80% of most of the companies in my portfolio. But I mean, as a DIY investor, it's hard to have all the time put aside to keep that much of an eye on 20 or 25 companies. But I think by accepting this, I don't kind of trick myself into thinking that I know more than I do, and then weaving it into smart stories about companies. So I just kind of try and keep it simple. Great companies, leaders in important emerging industries. It's probably going to do all right. And yeah, over the last 5 years, that's kind of how it's played out. And the worst investments I have are the ones where I've deviated from this approach. Apart from some of those really bad ones in 2022, like Teladoc and Unity Software, and I see a little smile for Teladoc. It's that was a tough one.
Yeah, that didn't go well for me either. It probably went the same way it went for you, since it's the same stock. But I hear that. I mean, the problem with Teladoc is I think probably both you and I misjudged how important this emerging industry was going to be. Telehealth didn't really become that. Turns out people actually go back to doctors. Who knew? But I definitely remember around that time that you're describing here. The guys at Motley Fool, they run a podcast. They are after listeners the same way we are. That's not a criticism. That's an observation. It's the nature of the event. They got to a point, certainly, where they, I think, were down probably slightly worse than you, with some hypergrowth things that had done very well in previous years. And suddenly the realization appeared to dawn on them that these things are meant to have valuations. And people, it turns out, are all looking at this and saying, but valuation all of a sudden, when a year ago they didn't care either. I was reading through the comments actually on your the episode that you did with us from 2 years ago. I'm pleased that you've now managed to make it back past the All World Tracker thing, because here's one that stood out to me when I was reading it before. A guy called Andy Pickin, who has been a very good commenter for us and a big, reasonable fan of the show, and we quite like him, said the following about, well, you. May I say what an enjoyable listen this episode was, having come to the conclusion that most YouTube investment gurus, not that we ever called you one of those, by the way, are know-nothings and grifters. I was pleasantly surprised to discover how balanced, considerate and interesting your guest was. Couldn't help but reflect that for all his training and knowledge, his personal portfolio was still short of the performance of a dumb S&P 500 tracker. A very thought-provoking and transparent post. Thanks again, Andy. All very fair stuff, I thought, from Andy on that. But you are back in the race, and it's now made it back past the all-world thing, which admittedly has the disadvantage of being hamstrung by everything from the UK. But investing's a long-term thing, right? You can't just look at when growth stocks or whatever go out of fashion. And there's a lot into your approach here that's built around things like market position, which doesn't change if you get it right. You may judge it wrong, in which case then it might change. But defensible competitive advantages and leaders in emerging industries and those sorts of things, it is often surprising how much, even as someone who probably has more of a value bent, certainly than David Gardner anyway, who doesn't, but someone who kind of worries a lot more about valuations, I think, is a fair way of putting the way I think about things. I am constantly impressed at the way of find something in the right place, in the right direction, in the right time, and actually don't worry about what the chart looks like. I've got that right sometimes and wrong other times, but stuff like Games Workshop in the UK, where I've looked at that and thought, I am buying this right at the top of a big curve, and it keeps curving, which is good for me here. Consumer appeal, I agree with you, by the way. Probably the weakest of the appeals, but that's actually quite a good example. Sorry, back to you.
No, I was just going to say, I do. I think I was listening to a podcast recently, and you mentioned that Games Workshop is your biggest position, I believe. I might be wrong there, but I know it's one of your larger investments.
You're right. I mean, it's become that way mostly because things around it have gone down. But yeah,
And that is, that's kind of funny because I've always got the impression you've been a bit more value conscious, certainly than the other Steve as well, and certainly than myself. And Games Workshop is probably, that's even a company that I struggle to get my head around the valuation. I've only very recently added it to my portfolio. It's a company I've wanted to own for a very long time. I've always been scared off by the valuation of it. And I decided this year, finally, like, I'm just gonna bite the bullet because it's got I can really see it's clearly an incredibly well run business, and you can kind of see catalysts for it in the future. Um, but no, I remember when I was listening, I heard you say that that was one of your largest, if not your largest investment. That um, I know. I just thought I remember thinking it was interesting because I knew that you were more value conscious. I think.
yeah. So you're not wrong about any of that. I think strictly what I said, just in the interest of making sure my listeners get the right idea. It's the largest thing in my stocks and shares ISA, but Berkshire Hathaway is a big part of my lifetime ISA. And adding that stuff to the stuff in my stocks and shares ISA takes that to be my biggest kind of single investment that I would be in. The most strife of it, well, suddenly went bankrupt or something, unlikely in either case. But I won't rehash my Games Workshop thesis here for the moment for people. But what I will say is a lot of your things, whether it's Axon or anything else for the time being, it's fair to say their kind of big cash flows are still ahead of them, at least relative to their market cap and their enterprise value. Do you see your approach changing as you get older? And sort of, I'm not to think about a time when you don't have 15 years left necessarily, but when you want cash sooner rather than later.
Oh, definitely, definitely. I mean, my approach is, I mean, it's even changed a bit now. Definitely now from where I started. So, for example, now basically a FTSE World ETF makes up just over 20% of my portfolio. So, I have this really terrible habit of treating it as if it's cash and occasionally dipping into it for individual stocks. I need to remember that's not quite why it's there, but you know, I do that to try and have a little bit of balance because I felt like my portfolio just simply was not, and 2022, 2023 was a very, very painful wake up call for this. Um, so, but I mean, how old am I? I'm 29. So I've got decades ahead. This isn't an approach I see changing anytime soon. I think the only reason it would change is if I decided I wasn't interested in researching and keeping up with individual companies anymore. But I think as I got to within 10, 15 years of wanting to take some money out, I think I would certainly shift more into global ETFs or global ETF, and potentially shift more into bonds or really just cash with a decent interest rate because I tend to not bother with bonds that much. So yeah, it's certainly not something that I think you should be doing if you're 60. Um, but you know, if when I turn 60, I'm still interested in individual stocks, I will probably still have a bunch in my portfolio, and they will probably still look like this. Just the weightings will be very different.
Still look like kind of the stage that your Axons and so on are at now, or they'll still be Axon, which might look different in sort of
Well,
40 years'
I
time.
mean, in if it is still Axon, I mean that will be quite something. I mean, of
It'll
the
have gone one or
companies,
two ways, that investment, won't it? If it's still there in 40 years'
yeah,
time,
yeah, exactly.
either you'll be recording things from the Bahamas somewhere, or it will have gone down to $1 somehow. I don't see that happening, by the way, but unlikely you'll sit tight on this while it kind of moves into stagnant growth mode. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account for Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.